welcome to Karora Resources Live Investment Summit today, hosted by Six. We're joined today by Paul Hewitt, Karora's Chairman and CEO, Oliver Turner, their Executive Vice President of Corporate Development, and Graham Sloan, the company's Managing Director of Australian Operations. The team's going to walk us through their company presentation, and after which we'll move to a live Q&A session where we'll be accepting questions. And you can submit your questions, of course, at any time using the Q&A panel found on the right-hand side of your screen. As always, the summit is being recorded and it'll be available to watch afterwards on Six.com. And without further ado, Paul, I'm going to hand it over to you and you can kick things off.
Thanks, Cam, and welcome, everyone. We're actually very excited to spend this next hour to go through our latest press release about our growth plan to 200,000 ounces a year. We're here in Perth, and unfortunately, it's not like in Toronto. It's not noon. It's midnight. So we're actually so excited about doing this that we don't mind whatsoever. However, in the last 60 minutes, I will inform you that we've been notified that Western Australia is once again back in lockdown. So COVID isn't over yet. And the one thing I will admit that I'm very proud of Graham and the team with what we have done here very proactively to deal with COVID as a whole. And I'm watching it firsthand here tonight as we're dealing with it, with the 100 calls we've had from miners, people that have to stay back on site, that are willing to stay on site. And thank you for all those people that are staying on site for us, and those that can't go to work tomorrow. So it's still active here. I'm hoping that everyone, wherever you are in the world, you're safe, your families are safe. And let's dive into the presentation. I'm going to have Rob go switching the slides, and we're going to turn these off. So slide 2 here. Myself, Paul Hewitt, Chairman and CEO. Before working with Karora, I was CEO and President of Klondex for 6 years, a little over 30 years of experience in mining. I started my career in Canada. I'm from Sudbury and raised in Timmins. So unfortunately, I was one of those bad hockey players in Timmins, and I got put in one of the mines in Timmins at 18 years old. To my right is our Managing Director, Graham Sloan, here in Australia with me. As most of you know, I've relocated with my family here in Australia with Graham. Graham is a veteran here. He has a commanding understanding of the capital markets, very good knowledge of operations, and has been our managing director for the last 2 years. Graham and I joined a month apart, actually. When I was hired, within a month, I hired Graham shortly thereafter. Next slide, please. Other members of our executive team, Oliver Turner, who will be on the phone here today. Barry Dahl, our Chief Financial Officer, he's actually just completed his my apologies, not his COVID, his quarantine, actually. Barry has just come out of quarantine yesterday, arrived in Perth 2 weeks ago. He's here for a month with us, going through the budgeting process and everything else. And Mike Doolan, Senior Vice President of Technical Services. The point of the executive team is always any group, anything you're doing, whether you're putting together bow ties or running shoes. In our case, we're producing gold. Has to have a strong executive team and a team that's committed. And we certainly have that, and a very well-experienced team. I want to go to the next slide, please, Rob. Actually, before we move forward, I just want to bring everyone's attention and remind you to please review our cautionary statements regarding forward-looking information and non-IFRS measures. They're not only in here. If you ever need them, they're in our news release and other places you can find them. Rob, the next slide, please. This slide really talks about the highlights of the press release that we put out earlier today. And look, this has taken us well over 9 months to prepare. There's been thousands of man hours and consulting hours to prepare and produce this product that we've put together. And we're actually very eager and very excited to deliver it. And then the tough work begins when you start actually delivering on it and executing it. But we've got a good reputation of executing since we've turned over to Karora, directly focused on gold. So today's announcement of our plan to grow to 200,000 ounces by 2024 is actually the most significant milestone for Karora since the actual acquisition of the mill back in 2019. We certainly believe this should result in a re-rating of our stock as we continue to execute the plan. Let's look at this table here first. 2021, you see a range here of 105 to 115,000 ounces. And I'm happy to say here tonight at midnight here in Perth that we are on track to deliver that performance this year. Q2 is almost behind us. The year is going well so far. Looking forward into 2022, as we just published this morning, we have a range of 120 to 140,000 ounces. 2023, 150 to 170,000 ounces. 2024, the big year, 185 to 205,000 ounces. Very, very close to having a 20% increase year over year. And some of you may recall that our 21 guidance is 21% over last year's actuals. So 2020 was our first year of production, and we achieved those 99,000 ounces. So at the same time as we're focused on delivering this aggressive production profile, we're going to continue to focus on cost reductions, targeting a $900 all-in sustaining cost or better by 2024. Asic reductions have been an objective of our focus since day one. We've already been successful in reducing all-in sustaining costs from approximately $1,200 per ounce to our current average today, which is $1,000 per ounce. I want to reiterate something that was clearly written in the press release that is very important. We were just on another call with several analysts here discussing this. This plan is an organic growth plan that will be funded from our existing cash balance of $80 million and expected cash flow from our operations from the future plans. There are some other significant upside projects and opportunities that you don't see here on the slide or that weren't in the press release. And I just want to talk about several of them so people can get an understanding of them. We've been talking about them for some time. I just want to remind people that some of the upside that we do have. First one is at Beta Hunt, we have the Larkin Gold Zone. It was a new discovery last year. The drilling success in Larkin Zone at Beta Hunt could provide near-term higher grade production potential, and is not even reflected yet in our mineral resource or reserve statement. And this 3-year outlook is completely based on that December 2020 mineral resource and reserve statement. There's also significant byproduct in nickel. That's a huge differentiator at Karora. I've been in mining 34 years now. Not too often in my career do I get to enjoy a byproduct credit. I remember one mine that I worked at for years, the Midas mine, that enjoyed some silver byproduct credits, and they are a huge differentiator. We've been mining so far a lot of remnant areas. We put out the first maiden nickel resource in the December resource statement. We've got the new 30C and 50C zones. We've been seeing savings anywhere from $35 to $45 an ounce already. We're hoping to realize continued savings like that, similar or even better. And look, our grade has been about 2.6% on the average nickel that we've been sending to BHP. Some of the results that we've had at 30C and 50C are in excess of 11%. Some are over 18%. So look, you can do the math. It's not hard to do the math. We're realizing $35 to $45 an ounce on 2.9%. So you can see why we're so eager and excited to actually get into these new areas, understand them, and really use them efficiently as a byproduct credit. In fact, we're so committed to understanding and tapping into the nickel that Graham, alongside with Steve Devlin, have appointed a new geological team specifically committed and devoted to the exploration at our Beta Hunt operation. So we're going to start to see some of their efforts and some of their fruits in Q4 of 2021. So it's really near and right around the corner. A couple other upside projects that I want to mention here are Lake Cowan. Look, Lake Cowan is in such a unique district. It's along the same strike and same geologic formation as several other very, very big deposits in this district. We've got to the north of us, Kalgoorlie, most of you know, produced 50 million ounces. Directly north of Higginsville or Lake Cowan is Campbell that produced 15 million ounces. Directly south of the Lake Cowan is 6 million ounces with the Norseman. We're surrounded by some massive, massive large deposits with that one intercept. And we've got a crew or a team, actually, a consulting group working at finalizing a desktop study for us now. All the drilling results are in. We're getting together the assays. We expect to have that result. We had to hire an independent group. We just didn't have the bandwidth with all our people working on the growth plan and other things. We had to hire a consultant to help us prepare that desktop study to give us some good indication of what to do next, taking into account all the geotechnical information, geophysics, all the information from soil sampling, the structural, everything that we have will be put into this report. Obviously, the drill hole success that we had is very critical. A couple other opportunities here. The amount of money that we're putting into the ground year after year for the next 3 years is similar to 2021. It's arranged $20 to $21 million. That's going to be split between exploration and resource definition. In this plan, none of that drill bit, none of the information from that drilling, we're talking the next 3 years, $60 million, none of that upside is included. Look, personally, I find that extremely exciting. Again, in my career, I haven't been able to see budgets like this with drilling. So we're very, very committed to our own growth. Lastly, but not least, our very large Mount Henry project area, which has almost 1 million ounces that we plan on continuing to drill and evaluate for higher grade zones. In the end, look, let's face it, grade is king for us. We recognize that Mount Henry is a great asset, and let's not forget it was being mined by the former operator when we took it over. Simply put, we have areas that are better grades in the next 3 years, and we will continue to mine areas that command us the best margins for our shareholders all the time. One thing that is excluded from this slide is our intentions to refinance our $30 million debt facility to a much more favorable interest rate that will provide us additional flexibility in the future. Our debt was actually originally secured when the company was acquiring the mill, and at that time, we had no historic production. So as previously reported, we paid 10% interest on that debt. We've paid down $5 million towards the principal over the last couple of years. Today, currently, Barry Dahl has several term sheets from bankers in front of him that he's reviewing. We expect to have this completed in the coming months, and we will get much better rates. And we're exploring revolvers as well at the same time. Look, there's no doubt, most of us know the best time to put in facilities like this or get money like this is when you don't need it. And it's to be proactive. And in this case, that's exactly where we're at. So we're being proactive here. Rob, you want to go to the next slide, please? This next slide here is really a slide showing our track record, showing what we've actually accomplished over the last 12 to 18 months. It's giving confidence that what we say we're going to do, we're actually able to do, supporting our 3-year growth plan. So the Karora team has a proven record of delivering on our commitments. I was thinking the other day, I was talking to Graham about going into meetings. We go into meetings with analysts all the time or our shareholders, and it's very often that one of the investors or one of the funds will put the presentation that I had from them a year ago. They will sit it down and then they'll open up the presentation that I have today. And it happens even more during COVID, actually, where they take the slide deck I had a year ago, and then they take the one I have today, and then they start comparing notes. And it's very interesting. I've had it happen already 5 times with Karora, where a shareholder goes, what's really impressive and I'm happy about, Paul, is the fact that I look back a year ago and I look at what you're showing me today. You've really delivered on what you said you've delivered. But let's just never mind that, and let's just look at the facts. So the first fact was our guidance of 2020 was 90 to 95,000 ounces to the street. We actually produced 99,000 ounces. And again, I know I said this earlier, but it is important. It was our maiden year. It was our first year owning our own mill. We're talking about going to 200,000 ounces here by 2024. That's a huge, huge step here. And we've de-risked it. You'll hear how we're going to do this. Graham's going to talk about it. We've de-risked this significantly. Despite all the significant external challenges that we've had with COVID, we went through some tremendous fires. We went through floods. Look, we've been dealing with manpower shortages. Our operating team has maintained an excellent record of reliable performance with 7 consecutive quarters of consistent production at that 25,000 ounces per quarter. Again, achieving our guidance. We successfully delivered on a number of cost reduction initiatives to achieve an average all-in sustaining cost of approximately $1,000 an ounce in 2020. We did this by focusing on several things: the royalties that we've talked about, the vendor negotiations, productivity improvements, and reduction in our G&A costs, as we promised. In 2020, we actually had we delivered our first maiden consolidated mineral reserve and resource. Once again, this is forming the basis for the 3-year plan we just outlined. And look, I'm confident there's plenty more to come from future drilling. In 2P reserves, we had, well, you see it up on the screen, 1.33 million ounces, and in consolidated measured and indicated, 2.52 million ounces. And again, in an amazing jurisdiction, and we've got 1,900 square kilometers here with aggressive drill budgets in front of us. You want to go to the next slide here, Rob? This slide here is looking forward again. So I went to the press release, looking backwards, and this one here is really looking forward. And after I'm done with this one, Graham's going to dive into more of the details. But before I pass it over to Graham, I just want to talk about this slide. We've really carefully phased construction approach, which results in a consistent level of growth spending over the next 3 period. What does that mean? It's simple. There are no major bullet payments in this plan. There's no major capital things. So we don't have one big, large capital item. And this is completely phased through the entire thing strategically for ourselves so we can use our own cash. If you look at the production profile, you clearly see we have taken a responsible and low-risk approach to our growth plan. That is also evidenced with our decision to develop a second decline at Beta Hunt. And again, Graham will speak more on this afterwards because we did have a number of alternatives besides the ramp to evaluate. It wasn't just the ramp. We looked at a shaft, conveyors. The ramp works to be the best. And again, I'm not going to steal Graham's thunder here. Over the last 2 years, we've certainly learned a lot and performed very well with optimizing our existing decline in infrastructure at Beta Hunt. Our objective is to replicate this success with this plan that we've outlined and with the press release and the guidance we've put forward. Just one example, 2 years ago, when Graham and I walked through the door here, I remember this very well, actually. We struggled to get 37,000 tons per month from the existing ramp with the fleet and with the infrastructure. Today, under Graham's leadership, we successfully haul 80,000 tons of ore from our existing infrastructure. That is more than double from where we began 2 years ago. That has a huge impact on productivities and costs. With the addition of another ramp, we can duplicate this, and it provides me and many of us here with a lot of confidence. Looking at the row with our growth capital, it can roughly be summed up with 3 specific items that we have. There's 3 growth items besides the normal waste development and raises that we would do if we didn't put up this growth plan. So the three outliers are the Higginsville mill, the expansion to 2.5 million tons, and that is in that growth capital, which is on that second row. It's about $50 million of those dollars, the total dollars. The second is a decline, the new decline. It's about 4 kilometers in length. It's about $45 to $50 million. So we've got the mill at $50 million. We've got the new ramp, $45 to $50 million. And then in order to service the ore and drive that ramp, we're going to need some new gear, some new equipment. There's about $8 to $12 million of equipment. The rest of that growth capital is growth capital that would have been there even if we stayed at that 100,000 ounce a year marker. So this is a tremendous message and story for us. Graham will get into more detail, but overall, look, we've developed a plan to take us to a range of 185 to 205,000 ounces within 3 years, primarily through 2 things: Beta Hunt and the expansion of the mill. This is something that not a lot of companies can boast, but certainly something I'm extremely confident we will be able to deliver. I'm going to turn it over to Graham. I know that there's probably a lot of questions lined up, so we'll get through Graham and then we're going to open it up and turn our cameras back on for questions. So Graham, all to you, sir.
Thank you very much, Paul. Look, as you can see on this slide, it's the key highlights. It's the key highlights for the growth plan milestones. And if you look at the first tab, the remainder of 2021, we'll continue with the necessary studies. We'll look at continuing the pre-development works we already started, and the drilling, which will have a strong focus on the upper extensions of Beta Hunt, including Western Flanks and A Zone. Plus, at this point in time, we may also take the opportunity to place some of our first long lead items for the mill and for the mining equipment. At Beta Hunt, we'll commence the second decline, Q1 2022. That'll continue through to mid-2023, and will also include an upgrade to the ventilation system, which will be carried out during the same time. The second decline, it will be in place and will progressively ramp up to a production rate of around 2 million tonnes per annum by the end of 2024. Now, we may take the opportunity to use contractors, or we may use owner-operator to establish that second decline. If we use contractors, it will delay the expenditure for some capital equipment items, and it'll also leverage off the contractor workforce. So there may be some opportunity or some benefit for us to work with contractors rather than our own. In Q1 2022, we'll also see us commence pre-development works on Phase 2 mill expansion, with construction to be completed by mid-2023. This will take the overall Higginsville mill capacity to around 2.5 million tonnes per annum. All of this will lead us to the targeted production rate of that 200,000 ounces, which is expected to be reached in the second half of 2024, as shown on that slide. What is important, even with all of this work going on, we'll also be advancing a number of other projects, which will be covered later in this presentation. If you go to the next slide, Bob, please. Now, I think this is a great slide because it clearly demonstrates the flow of projects to meet our production forecasts and beyond. For some time now, we've been highlighting the tremendous potential of Karora's very large land package. The tenements are all on the same major structure as Kambalda, Kalgoorlie, Norseman, all of which have a combined gold endowment of over 75 million ounces. Our Higginsville tenement sits right along strike of these and has a tenement package of some 1,800 square kilometres. To this day, really are largely unexplored, due largely to the impact of the earlier royalties Paul mentioned and the lack of expenditure. We have removed all of those royalties, as we said, put a great exploration team in place at Higginsville and Beta Hunt, and have a very strong exploration budget of that plus $20 million for a year for the next 3 years. The slide will also show, the various stages of the individual projects with a bubble size representing the approximate relative potential. From the slide, you can see Beta Hunt is by far the dominant operation to supply feed to Higginsville Mill. Now, again, importantly, this slide does not represent the upside opportunities at Beta Hunt, which include things like 30C, 50C nickel discoveries, parts of the Larkin zone, the additions of the extensions to Western Flanks, A Zone and Fletcher, all of which are either in early stage of development or exploration. You can also see that there's a large number of projects in the operating section there of the slide that provide the balance of the feed into the Higginsville mill, and that will put there to provide the best possible mill blend for the optimal gold recoveries. So this gives us the ability to have the flexibility around operating each of those areas. Rob, if you could go to the next slide, please. This is a plan view of Beta Hunt's growing footprint. As I've previously mentioned, Beta Hunt is the backbone of the growth plan, with production approximately doubling from our current 75 to 85,000 tonnes a month to around 160 to 170,000 tonnes a month by the end of 2024. What is really not evident from this slide, and I do apologise for this, but it doesn't clearly show just what the Beta Hunt ore system is. It's now over 2.5 kilometres long along strike in the gold zone and another 2.5 kilometres along strike in the nickel zone, making this over 5 kilometres of mineralised system. You don't often see this in mines in Western Australia or in most places, both gold and nickel. Also not evident in this is the window that those historic open pits, and those little dark shapes you can see there in the bottom right-hand corner of the slide, they're like a window for our exploration team, because they could, in fact, provide a clear indication of what lies down 300 or 400 metres below the surface, what we're currently mining or plan to mine. So they're a good exploration indicator to what we could be seeing. So very important to our exploration team. If you slip over to the next slide, Rob. Now this shows a schematic view of the planned second decline at Beta Hunt, which is shown in gold. You can see there the top left-hand part of the slide. When the expansion is fully ramped up, each decline, the current one and the new one, will have a capacity of around 1 million tonne per annum for ore haulage. The second decline option was the result, as Paul mentioned, a very extensive study undertaken by Hatch to assess the most economical and practical haulage options for the increased production. And it was very clear from the study the second decline was the best option. And that was based on a number of factors, including the lowest risk, the lowest capex, production flexibility, quicker access to ore, and really no specialist experience was required to be able to carry out that decline. It's something we're doing now, and you didn't need specialist people like you would for a shaft and for the conveyor option that we looked at. So we already have, as I said, access to or can source trained and competent and experienced workers to undertake the second decline. And it really is part of our normal day-to-day operation. And we'll have to obviously mirror the existing fleet. But again, this is all within reason. And this equipment, readily available, contract, second-hand or new. And some of this we'll place on long lead items to arrive when required. If you change slides, Rob. This slide zooms in on that upper portion or upper section of the planned second portal and decline and highlights a near-surface drill target, which we're currently drilling. And this target, we think, could be either extension of A zone or western flanks, or in fact something new. So it's really exciting the way this drilling is happening from the surface, and we hope to be able to put something out in the near term. The position of the new decline will provide early access into any of that, what we find, and in fact some of the upper ore level extensions that we already know, like A zone north and western flanks north. And it provides early production opportunities from these and other sources. If you change slides, Rob. The Higginsville plant, well, it's currently operating at around 1.5 million tonnes per annum, and by the end of the year, we should be up to 1.6. All this is part of what we call Phase 1 mill expansion. Phase 2 expansion takes the mill to 2.5 million tonne per annum. We'll commence that, as I said, in early 2022, and will cost around $50 million. And I talk in Australian dollars for this, unfortunately, and I do apologise. Phase 2 will consist of the addition of a new SAG mill. It will have changes to the feed conveyor. A section of the crushing circuit will be repurposed as a pebble crusher. The existing mill, the ball mill, the upgraded gravity circuit, lucian columns, etc., they're all being utilised as part in Phase 2. There will be additional leach feed screens and tanks and thickeners. And there'll also be an upgrade to the processed water and tails pipeline. So lots of work. The final result, 2.5 million tonne per annum plant, capable of blending the paleo channel material from central Higginsville, which is very important for us. We'll have sufficient tailings capacity for the next 5 years, all of which is funded in the growth CapEx. Next slide, please. This slide really just provides you an idea of the main production centres at Higginsville and their location to the Higginsville plant. And as you'll see, the newer ones are very close and certainly within mine trucking distance of the Higginsville plant. And this includes Two Boys, which is less than 500 metres away, and Aquarius, about 2 kilometres away. To the east of this, or to the right of that screen, you'll see that Baloo sits about 14 and Hidden Secret about 10 kilometres away. Two Boys mine, when they put a load of ore into the truck underground, they'll drive the truck up to the surface, turn around, and same truck, and drive straight up into the Higginsville ROM, all within 500 metres from where they started. So it's not often you can see that sort of closeness or location with deposits. Rob, if you just slip to the next slide. At Aquarius Underground, we commenced pre-production activities at Aquarius in this quarter. We'll have the box cut, the portal will be completed by early to mid Q3, and with the decline well underway by the end of Q3 this year. Whilst mining the box cut, we'll have intersected, and we have intersected near-surface Super G material, all of which will be mined and milled to help offset the development costs. Level development into our first stoping blocks at Aquarius is expected to begin in late Q4 2021. So really not that far away. The Aquarius deposit remains open along strike at depth, and we are planning follow-up drilling to be carried out from the lateral underground development because it's cheaper and quicker and there's less holes required. If you move to the next slide, please, Rob. The Two Boys, well, this Two Boys mine has a very good pedigree. Historical production from Two Boys is around 90,000 ounces at a reconciled grade of 14.9 grams per tonne. Throughout the first half of this year, we have rehabilitated, we've dewaterd over 1,000 metres of the decline. We've accessed some of the remnant ore blocks in the upper areas of the mine, and development is on track. We should reach new production zones in the second half of this year. We'll put an updated development and Stoke Production plan is currently being finalised, which will include some of the face samples we've been taking, some of which are around that 5 to 10 grams a tonne. Our average mine grade is expected to be around +4 range, and given its close proximity to Higginsville, once ore is loaded in truck, as I said, very, very short haul from Two Boys into the mill. Next slide. At Spargos, well, this shows a long section of Spargos deposit looking east. You can see from the section, Spargos has a strike of around 250 metres, but very interestingly, we're seeing a vertical depth twice of that. So we're down to 500 metres and it's still open. Historical production from Spargos, which was first mined in the early 1940s and then again in 1980, was around 50,000 ounces at a grade of 8 grams a tonne. So we are certainly looking to expand this whole Spargos deposit. In Q1, we commenced our pre-development works, and we're on track to deliver first ore into the mill by Q3 or early Q4 of this year. So again, another high-grade ore source coming into the mill the latter part of this year. The new mineral resource you see there is predominantly focused on near-term open pit mining, which the open pit will look to mine in 2 stages. What we are seeing at this point in time, and certainly leaves us in no doubt, that the Spargos system has significant potential both at depth, down plunge to some of those high grades where you see those arrows plunging down to the right of the page. And certainly some of those are very much higher grade than what we're seeing. In fact, it's interesting that when we closed up the drill space in the grade control, we identified 2 very high-grade shoots. Now, these shoots are like cigars. They're about well, hopefully a cigar is not 100 metres long, but these things are about 100 metres long. They're about 5 to 10 metres wide and high, but they grade in excess of 15 to 20 grams. Now, we've identified 2 from the recent grade control drilling. As we go deeper in the underground and start some of the close space drilling there, we believe there's a very good chance we'll find some more of these, and there'll be repetitions of these as you go deeper in the system. So again, lots of potential at depth, lots of potential down plunge, and also lots of potential for these high-grade cigars, if you like. So really, when you think about it, it's not a bad purchase for an asset that we paid sort of $4 million for. On the regional scale in and around Spargos, outside the main Spargos pit, we have a number of other targets, all of which require additional drilling and exploration. These include the Lady Allison, which is about 5 kilometres to the west or to the left of that picture you see there, or to the left of the main Spargos deposit, and also the what is known as it's yet to be named. It's a deposit or a project 1.5 kilometres south of Spargos, which has quite unique style porphyry-controlled dilational target, if you like, and which has a number of very good drill intersection into it, including 14.1 over 2 metres from 5 metres below the surface. There's another 48.5 grams per tonne over 1 metre from 2 metres below the surface. And then there's 7.7 grams at depth over half a metre at 44 metres. So this thing does have some depth to it. It does have shallow mineralisation. It's a great a long strike of the existing Spargos. So it ticks all the boxes to be potentially something quite bigger than just an exploration prospect. Only more drilling and a bit more sort of work in and around sort of the geological geochem work that we need to do there. All of that shows that we've got plenty of potential in and around the Spargos area. Slide, if you like, go to the next slide, Rob. At Beta Hunt, on the sort of, this is really outlines the major upside projects remaining at Beta Hunt, and we have a number of very strong follow-up targets, both from a gold and nickel perspective. And these, as we've mentioned before, include the Western Flanks North, the A Zone North, the Fletcher, the 50C nickel trough. And you might remember the 50C discovery includes an intersection of 11.6%, I think, nickel over 4.6 metres. I think that's right. And then that includes, I think, 18.4% over around 2 metres, all in a hole there. And certainly the drilling that we've seen following up looks to support some of those sort of numbers. So that's a very, very good deposit or a project for us, and we'll continue drilling that over the remainder of the year. Larkin, as Paul mentioned early on, is another great target. We've over 50 drill holes in so far with something like 9,500 metres of drilling. And the initial Larkin mineral resource we'll expect to go into the 2021 Consolidated Resource and Reserve Update sometime later this year, early next year. So when you look at Larkin, directly above it, and this is one of the key reasons around Beta Hunt, you look at Larkin, a 30C nickel trough sits directly above Larkin. And to date, that 30C nickel trough has returned some cracking grades of 8.5% nickel over 1 metre and 7.5% nickel over 1.3. Again, we are developing along the Larkin lode, and we'll use Larkin as a drill platform to drill holes up into the 30C nickel trough. So Beta Hunt really is this mine that just keeps on delivering. It has done for 40 years up until now, and things are looking very, very good for a lot more years in front of us. Next slide, thanks, Rob. This at Higginsville, on the exploration potential, as we've been saying for some time, Higginsville exploration potential really quite exceptional. At Lake Cowan, all of the air core drilling results have now been received. They are currently being analysed for the next phase of targeting the work. The highlights from that drilling, you might remember from a press release we gave, that we had an intersection of 1.35 grams per tonne over 50 metres. Now, this is from air core. And when you talk grams per tonne in air core is really quite special. Typically, you work you work sort of parts per billion. So this is parts per million, a lot better than, far better than what you'd normally expect to see in air core drilling. In that 50 metres included 16 at 3.6. So again, really exciting. Now this is north of an existing prospect you see on that slide called Monsoon. And you'll see that all of those, the that data was released in February 8th, 2021. In that 2016, there was an IMSET of, I think, 11.4. You'll see written on there, 11.4 over 66 metres in hole 313 and 6.4 grams over 38 metres in hole 320. These were reported at the Monsoon project by S2 Resources. And again, if you look on the slide there, from Baloo to Monsoon is about 5 kilometres directly down strike of it. And then from the 50 metres at 1.35 to Monsoon is probably about a kilometre, just over a kilometre, so a kilometre and a half. So you can start to see why we get pretty excited around this area over there. And as I said, we've yet to really follow up on these. And certainly when we do put all of the air core together, we'll have, and we'll look at a desktop to rank and prioritise the drilling. And we will look to start drilling back there early 2022. So really across Beta Hunt, across Higginsville, across Spargos, this growth plan, low risk, we have the people, we've done this before, we're doing it now, and really to meet that 200,000, I think we've taken a lot of risk out of where we need to go. So I now turn over to Oliver.
Yeah, thanks, Graham. So on this slide here, obviously 2 weeks ago, we announced this partnership with the Net Zero company. We are seeing a tidal shift in the way that capital is flowing across not only our sector, but sectors worldwide. And it's becoming more and more important to have a very strong ESG program, not only from a corporate or global corporate stewardship perspective, but also from an investor perspective. And what we're trying to do, or aiming to do at Karora, is to be one of the first in the junior gold space to become a net zero junior gold miner. This is the reason why we announced this partnership with the Net Zero company. We're very excited to do it. There's a strong team of professionals behind the company that's going to help us to devise a multi-pronged plan that'll focus on 2 areas: emissions reductions across the business, as well as driving investment into carbon sequestration projects. So we're excited to update the market on that as we move forward through the plan. Of course, a large component of this will be included in our inaugural ESG report in early 2022. So stay tuned for more on this initiative, but it certainly is something that more and more investors are looking for, and is a way for us to get access to that capital before some of our peers do. With respect to talking about the market, we've put together 2 slides here, giving an indication of where 200,000 ounces a year could take us from a market cap perspective. Obviously, elevating us into the 200,000 ounce a year category is a tremendous achievement in its own, but we definitely expect the stock to re-rate off the back of that transition. And when you look at the company in which we'll be once we reach 200,000 ounces, it's a pretty esteemed company, but I would also argue there's several factors that definitely differentiates Karora's investment perspective and investment conviction once we achieve that level. That is certainly the fact that we are in Western Australia, obviously a very low risk jurisdiction. Number 2, it is organically and internally funded. We do not have a major funding gap, which I cannot emphasize enough. There are not many growth plans in the world that have that. And certainly last but not least is the fact that we are duplicating an existing decline. Look, the last 7 quarters or 2 years of production, the operations team at Beta Hunt has done a tremendous job of optimizing that operation, and it really is flying on all cylinders right now. What we are doing with this second decline is replicating that success. So overall, a high conviction and very low risk growth profile. With respect to market caps that we could potentially look at, we're going to look to our analysts for their valuations of the work that we put out this morning. Obviously, they're working away on their models as we speak, and we'll be publishing notes. But just an indication of where the market is valuing 200,000 ounce year producers on average is north of that $1 billion market cap mark. So we would certainly enjoy a move up and to the right on this chart, and stay tuned for more details as we deliver them to the market. Last but not least, a corporate summary here. Look, our research analyst list has grown significantly over the last 18 months. The last initiation was by Ovais Habib at Scotiabank, which is our first major bank to launch in us. But all of our analysts have done a tremendous job in delivering that fundamental analysis and comparing us to our peers. And we have great support from all of them. More to come in the future. And of course, we've got great support from major institutions, but not only institutions, but very strong retail shareholders. And at this point, I think we want to hear some questions from those retail shareholders. So Cam, we'll turn it over to you to answer some questions.
Thank you. First question comes in from Dana. You show big growth without using an ore sorter. Is it still possible an ore sorter can be used on top of your other growth measures?
Actually, thanks for that question, Dana. Look, the ore sorter was something that I was pushing myself personally. And we have had the company on site. We've had 2 passes. So we've run the first pass through the ore sorter. And what's happened is we are not getting the right results that we're getting. So what is occurring is we have to do a second pass with the ore sorter. And look, this is a large piece of equipment that we have on site. It's been delayed because of COVID. The bottom line is with 2 passes, it's not economic. However, look, they haven't given up, nor have we. They haven't been able to give this study a full justice because of COVID in and out. And I just explained it today. Tonight we're on lockdown again. We have to get rid of a whole bunch of people on site. It's just the way it is. So we've struggled at doing the test efficiently. The 2 passes that we've come up with, look, if we could get the 2 passes down to 1 pass, it is economic. We would use it going forward, and we would be able to scalp tons and then replace it by higher grades. So we are certainly not giving up on it. We're still committed to testing it. It's taken more time than we had anticipated because of COVID. And I can tell you the vendor, he's chomping at the bit to try to prove to us that it can work with 1 pass. So just stand by. We will continue to update people. I wouldn't get discouraged. It's just a function of the reality that we're living in today.
Fair enough. Thanks, Paul. Dave asks if there are any plans to include share buybacks to capitalize on high ROE during times of market downturns.
I'll give that one to Oliver. I know that Ian loves these ones. So go ahead, Oliver.
Yeah, absolutely. So, it's a good question. And obviously, we do have that NCIB in place from the year before. We did renew it. And we will take strategic opportunities to be opportunistic. But it's very important when you think about the dollars that we have on the balance sheet today, that there are multiple uses for those dollars. You can deploy them into your growth plan, which obviously we have very high conviction behind. And we believe we can translate $1 into many dollars that way. There's paying down debt, which is another option. And of course, with the NCIB as well. So each time we look to move on that NCIB, we have to ask ourselves, what are the better uses of our dollar? And I believe what we've rolled out this morning is very, very high conviction with respect to what we can do with our money and how far we can stretch it. Remember, every dollar spent today either has to be generated back by cash flow later or it has to be financed later. And we certainly wouldn't want to pull an NCIB move, have the stock retrace and have to finance at lower prices. This is an organically funded and internally funded growth profile, and we want to keep it that way. But it is a good question.
Thanks, Oliver. Rainer has said this: I'm a shareholder with Mavericks Metals. Do they profit proportionally from doubling your production via their 4.75% royalty?
I'll take that one. Well, I will say, was it Rainer? Sorry, I didn't get the name. I apologize. Well, it's a Karora episode, but you're right, Rainer. They are still a royalty holder. And there's no doubt, absolutely they will. There's no doubt that Maverick shareholders will benefit because we're going to produce twice the amount of ounces, so they're going to get paid for that. However, I want to comment that our shareholders are going to benefit significantly as well. Had we not done this, we're talking, it was around $43 an ounce. Look, 200,000 ounces, what's the math? $8 to $9 million on savings for our shareholders, the Karora shareholders. So I'll twist the question around. Yeah, Mavericks, they're going to do well. Our shareholders are going to benefit even more because this is a long-term thing here that we're thinking, and $8 to $9 million savings in 1 year. I'll take it any day of my life for my shareholders.
Absolutely. Thanks, Paul. Mike has asked this. At this time, what is the total estimated nickel resource in the HGO Beta Hunt areas, or is this currently being analyzed?
Yeah, I'll take that one again. Look, I'm sure I think I mentioned it earlier, Cam, but Graham here, who's sitting across from me, has just recently appointed with our VP of Exploration, our VP of Geology, a new team devoted to the nickel. The nickel is such a tremendous unknown and opportunity. Look, Beta Hunt was a nickel mine for 40 years. We're working in a nickel district and we've got gold associated with it. What a benefit to have here. This is, I don't know how much more exciting you can get in this district. We drill one hole, we drill through gold from the bottom and we hit nickel on the other end of the hole. We drill from the top down, we go through nickel and we hit gold on it. So quite exciting. Now let's think about it. We've hit the 30C, we've hit the 50C. We've published numbers in excess of 11%, 18% nickel. You can see why we've committed a complete team dedicated and devoted to this. Once we recognize and start realizing this on a consistent number, if we can get to, I don't know, let's throw a number of what if we get, we're 35 to 45, what if we double that? Our average grade has been 2.9%. I've just shared with you some of the grades from the intercepts we've had. They're 8, 11%, up to 18%. You can start doing the math in your own head and go, all right, if they're 3% now, they can start mining areas that have double the grade. There's just so much opportunity, and putting that team together like Graham has done was absolutely the right thing to do. And look, stay tuned, because I'm as excited as anyone else to see what we're going to unlock with this nickel in this Beta Hunt mine. Graham said it best. Beta Hunt's that mine that keeps on giving, and it will continue.
That's great to hear. Well, listen, I think we're running short on time at this point today, so I wanted to thank everyone that's in attendance, as well as the whole team for that presentation. To the audience, if you didn't get a chance to get your question answered, or if you think of one after the summit, don't worry, we'll be sending out a short survey where you can leave your contact information and get in direct contact with the Karora Resources team. You can also, of course, find more information at karoraresources.com. And with that, Paul, I'm going to hand it over to you to end things off for us.
Thanks, Cam. I really want to thank you, Cam, for hosting it. And I want to thank everyone who joined us today. Look, this was a full hour. I hope that we answered a lot of your questions with the actual presentation. We're hoping that what we discussed, we hope that these summits add value. We hope that when you hear us speaking and we get to answer a certain amount of questions, that it's adding value for you. I also want to just take a brief moment and thank all the people who work such long hours through weekends, making all the sacrifices necessary to deliver this growth plan on time. Again, one more thing that we can tick a box and say we did it on time, as promised to the market. And to all of you that are our shareholders, we thank you. We're all in for some very exciting times, so hang on to your helmets. We're in it together, and as many guys on my team say, onwards and upwards. So have a great day, everyone. Thanks very much.
Cheers, everyone. Have a good day.